So, how do you invest as you get older? Um, I remember when I first started investing 25 years ago, this was like late 90s, 97, 98, like a couple of years before the dot com bubble burst. And I didn't really know anything about investing. It was one of my first jobs out of college and very small company, startup, and there are a couple of guys there that invested in technology mutual fund at the time, and I started out as a tech guy in my career. So I started investing in that fund. I think at the time it was called Fidelity Select Electronics. I think it had like a 5.75 front end load, which is crazy. So basically, as soon as you buy it, you're already in the hole almost 6%. But at that time, technology stocks were just going crazy. So you made it up pretty quick. And, at one point I was up, I think, like 100 grand at some point, and I was like 20 something. Um, of course, everything came back down to earth, and what was it, like March of 2000 when everything just crashed. Um, so my investing career started out with like that mutual fund and a couple of other uh, technology stocks. I had individual stocks, I think, like Cisco, Nortel, Yahoo. I kind of forget them now. It was almost all technology stocks. And then, of course, once everything crashed, my whole portfolio crashed. And as everything was going down, I just kept putting more money in because the only thing I knew of is the market going up. And let me just buy the dip. And of course, everything just kept going further down. By the time I eventually sold, I had, geez, a lot of years of capital losses to make up for during tax time because I lost a ton of money. I probably lost like 40 grand or something crazy. Um, I mean, that was a big lesson, obviously, not to put all your eggs in one proverbial basket. And so over the years, it kind of changed the way I invest. After that happened, of course, I didn't have everything just in tech stocks, but I did buy a lot of individual stocks. At one point, I think I had like 20 different individual stocks. Um, and I don't know what it was. It was maybe like 7, 8 years ago, 10 years ago. I I had a pretty good historical track record because I was been using the same brokerage firm for a long time, and um, I went and I looked at my you know my track my track record for all that time investing, and I thought I understood the market pretty well, um, but I was still like maybe 3% behind the S&P 500 index. So it really made me think that stock picking, at least for me, didn't make any sense because there's no way I'm going to be able to keep up and research and keep up on the news of 20 different stocks. Um, and most people can't consistently beat this, the S&P 500 index over time anyway. So it was kind of like I had the evidence in front of me that I wasn't doing it. So like, what's the point? So slowly, over time, because of course there's tax consequences to selling. I slowly started selling my individual stocks and just buying into index fund, ETF, or mutual fund. Um, I had some bonds too. Sometimes I think I had too much for my age at the time. I think I had like muni bonds. Sometimes the more I like researched and learned, the worse it was. Sometimes it's just keeping it simple would have been better. I remember also having like a value based ETF because I like the dividends. But if you put it alongside a growth ETF, like even with dividends, the growth ETF, at least over the last 10 years, growth has been beating value. So, but I didn't fully understand the difference between value and growth. I didn't fully understand bonds. Like if yields go up, the price of the bonds go down, and if yields go down, the price of the bonds go up, like stuff like that. Like I just didn't, like I thought I knew it, but I didn't really. So at 50, like I feel like I have a better handle of what I should be in. I definitely try to keep things simple. So sometimes I look back and I'm like, oh, I wish I bought Nvidia like a year ago because it went up 100%. Then I'm like, oh, well, maybe I should be in individual stocks. But then I think back of the individual ones that I thought I was making a good bet and I lost a lot of money in. So I end up feeling worse when I lose money on a stock than I would if I made a big gain on it. So you're really gambling. So I feel like over time, obviously the stock market goes up most of the time over long periods of time. So I think for most investors, you're better off just putting it in a S&P 500 fund. And if you're retiring, the closer you get to retirement, you want to de-risk, right? Like if you see the market go down 10%, which happened recently with the correction, which is normal, and you freaked out, well, that was a good indicator that maybe you have too much risk in your portfolio because the markets are going to do that. And if you're a very new investor and you're just starting out, like I remember, of course, like I said, going through the .com, the 2008 crisis that crashed during COVID, where it dropped like 30% and shot back up. Like, things are gonna happen like that, and if you don't have the stomach for it, then it could mean that your portfolio might be a little too risky. So as you get closer to retirement, it's capital preservation, like especially once you get to a certain amount, you're like, okay, well, how do I not lose this because I need this for retirement? So you might want to start shifting your allocation from 100% stock down to 80, then 60, depending on how close you are. You want to make sure you have an emergency fund. I like to be more conservative. I like to have more cash on hand. So if, let's say, I do want to put money to work and the market's down, like I like to have some money on the sidelines. So for emergency fund, I like to be able to figure out, okay, like how much are my expenses if I were to lose my job tomorrow? How much money do I need in order to pay my bills for a year? I don't know, they say 36 months for emergency fund. I like to look at a year because back during the .com phase of things, I did lose my job for like 9 months. So when you have experience like that, and it was very difficult trying to find a job. I think at the time, like a job listing would come on, there were like 500 people in one day that applied to that job. I mean, everybody went into tech field, and then it was really hard to find a job. So I know you could be out of a job for a while, no matter what the job market's like, because the jobs that I was finding at the time, I would have been making like less than half of what I was making before. So even if you find a job, doesn't mean you're going to be making the same salary. So that's why I like to have at least a year's worth of emergency fund. And at least nowadays, 2024, although the Fed's going to be cutting rates in September coming up, you're getting 5% on your money, which for a lot of years, with rates being really low for a while, you really weren't getting very much on your money. So at least now having money in an online savings account as emergency fund at least doesn't hurt as much, because you're at least getting some money earned from that. I like using online banks, not your local brick and mortar. They barely pay you anything. You're never going to get the best rate going to your local bank. So that's how I like to park my emergency fund money. And so now I have a mix of S&P 500 index fund and bond fund. In my 401k, I have some international funds, although last 10 years, the U.S. market's been beating the international market. These are the type of things that I've read forever, like, hey, you want some international in your portfolio. But had I not had it in the last 10 years, I would have been better off not having it. But doesn't mean the next 10 years that the international won't outperform the U.S. So it's, you want to diversify, but you can do it in like 3 funds, like a total U.S. fund, total U.S. bond fund, international fund, maybe 20% international, 40% bonds, 40% U.S. domestic, some cash in there, 10%, at 51, even if I were to retire at 55, I'm probably going to stay around maybe 25% bonds, because I still got a ways to go, and the equities is going to give me a better longer term appreciation. Now, once I get into 65, 70, then yeah, I'm going to be more fixed income slanted, and maybe the bond allocation will be much higher at that point. So you got to really see, okay, what's your age that you're really retiring? How long does the money have to last? What's your risk tolerance? Some people are really aggressive, some are more conservative. Like I said, like everything, if you just start investing in the market, all you know is the market going up, like you're going to be in for a rude awakening once things go the other way. So it's kind of like going to Vegas, and I'm not a big gambler. I hate losing money, but I'll take some money and just use it for entertainment. But I know, like, I plan on losing it, and any money you put in the market, like if I lost everything that was in the stock market that I have, I mean, that would be terrible. So I'm not necessarily saying you're going to lose everything you put in the stock market, but at the same time, you have to think about it like it's kind of like gambling to an extent. So you really should do your research if you are going to buy individual stocks. But over the long term, I just think if I was talking to my younger self, I would have been better off just telling myself, in my early 20s when I was investing, just put it into an S&P 500 fund, dollar cost average in every month, and not even think about it. I just always liked researching the market and stuff like that. I used to work for a stock brokerage house and stuff, so I always saw the news and things like that on finances, and I liked just learning about it and keeping informed. But for the average person, you're going to be better off just putting it in something simple and kind of forgetting about it. As far as you're not going to have to put a lot of energy in keeping up with what's going on, just making sure that you're actually putting money in, because the earlier you start, the better. So that's like my investing strategy at this point in my financial journey, just keeping things simple, not having like a million stocks. If that's what you enjoy, like, you know, maybe take a handful that you just want to play around with, funny money, and see what happens. But I think by and large, for most people, it's just easier just to like be more passive, in a index fund like the ones I mentioned. So, how do you invest? What do you like? Do you like dividend paying stocks? Do you like what type of investments? And do you agree with keeping things more simple, or do you enjoy like having a basket of stocks and tracking them, and trying to beat the market, day trading and all that stuff? How do you do it? If you like this content, drop me a like and subscribe to the channel, and I really appreciate it.